Morning and welcome to our event today. I'm Mark Mazur. I'm the Robert C. Posen Director of the Urban-Brookings Tax Policy Center. And I want to thank you all for joining us today for our third conference that we've co-hosted with our friends at the University of North Carolina Tax Center and the Keynote Flagler Business School. We have a great program today looking at the potential for corporations to shift income between jurisdictions and the responses by tax authorities around the world. To get some intuition for the problem, think about a software company. Suppose that there's an employee in the US parent, comes up with an idea for an application that could be used by businesses or individuals. The idea gets developed by teams of computer scientists and data scientists and engineers all around the world. The intellectual property is protected by an international team of lawyers through trademarks, copyrights, etc. And then the product gets delivered to the ultimate customers via servers in the cloud. And the question is, where has the income from that product been earned? Our traditional approaches look at where the value is created and things like that. Those approaches are of limited value in providing a definitive and consistent answer. And it's not just digital products that create this concern. The same basic issues arise in manufactured goods such as cars and airplanes. What I'd like to do is go through a couple of housekeeping issues before beginning the program. First, today's session is being recorded and later will be made available online. All the participants who are joining us today are muted. Throughout the discussion, I encourage you to type your questions or comments in the questions box at any time. And just as if you were at this event in person, please state your name and provide your affiliation. We'll have folks monitoring the questions that are coming in, and we're going to do our best to answer as many questions as possible. I also encourage you to join the conversation in social media, say Twitter, using the hashtag income shifting. Now what I'd like to do is turn to the program. I am pleased to introduce our keynote speaker, Pascal Saint-Amand, the Director of the Center for Tax Policy Administration at the OECD, a position that he's held since 2012. I've worked with Pascal on international tax issues over the year, and I can attest to the fact that he is one of the most persuasive and persistent people who I've dealt with. And is incredibly talented at wrangling a consensus on very difficult tax issues. And that's just an incredibly valuable role in coordinating tax policy activities at the OECD. Please remember, if you have questions for Pascal, please type them into the question box, and we'll get to as many of them as we can. And now, I'd like to turn the program over to our first speaker, Pascal Saint-Amand.
Thank you, Mark. Good morning to you all, as I suppose you're mostly based in the US. I hope you're all well in spite of the current situation, which is quite frustrating. And I'm happy to talk to you from France, more precisely from Biarritz, where I have been confined, and we've just started deconfinement with a pretty good weather and the beach reopening. So that's a pretty bright day, brighter than the current economic situation or the overall worldwide situation. And I think confinement has probably been an opportunity for most of us to go back to basics. I mean, not going as far as the meaning of life, at least the meaning of what we're doing and what's the current state of play with a stock-taking exercise I suppose many of us have done. So I would like to start with that for a few minutes before trying to brief you on where we stand in terms of the negotiation you are all aware of. So on the back to basics, a few, very basic ideas. One, as many tax people joke about, there is no such thing as international tax, because indeed there is hardly any international instrument to regulate the confrontation of tax sovereignties across the world. This is true, but I would say this is less and less true, because over time, we've been able to build something like an international tax community with some hard law instruments and many more soft law instruments. And it drives me to the second reflection. The aftermath of the previous crisis, the 2008 crisis, has been populated with international initiatives served by the OECD Secretariat, which itself has served a broader and broader group from OECD member countries, which 10 years ago were probably in the low 30s. We today have 36 members, with Colombia having joined recently. And you may have noticed that Costa Rica has just been invited to join the OECD to, in tax matters, 161 members for the Global Forum on Transparency and Exchange of Information, 137 members to date for the BEPS inclusive framework. So institutions have changed, and these institutions have produced a corpus of rules like automatic exchange of information and transparency, and that's a game changer, and not only in the field of personal income tax or the taxation of savings located abroad, but also in terms of a network of tax administrations able to assist each other, exchange information beyond bank accounts, on transfer pricing, on the common reporting standards, but also on the country-by-country reporting and on many other areas. So there is an infrastructure which built, and of course we came up with the BEPS project, which is a game changer. Some would complain that we've moved away from the good old times where nobody was paying attention to international tax and clients were paying still a big amount of money for advice, to a situation where clients may still pay a big amount of money for tax advice, but with more litigations, more contentious, and more difficulties. That's one way of seeing it. The other way of seeing it is we've tried to keep countries together in agreeing some of the rules and limited unilateral measures, which were anyway booming in the context of the crisis. Another basic thought is that whatever happens in the US has spillovers for what I call non-US countries. As American, you may not realize that there are many non-US countries in the world, but they are. And they are impacted by what's happening in the US because of the size of the US market, because of the power of the United States of America as a country, and because of the success of American businesses, which are quite unique in their ability to grow and to grow outside their domestic market. And what's interesting in that context is the tax reform, which took place in the US at the end of 2017, which from a foreigner's perspective is interesting because it looks like it's a bipartisan reform, except maybe on the rate of corporate income tax, but on the broadening of the base, even though it was not adopted with a single democratic vote. But what fascinates me with the US tax reform is that it has a BEPS taste, which is quite, tasty indeed. And that means that this US tax reform allowed us to reboot international discussion after BEPS and its successes and its relative failures on transfer pricing, or on Action 1, which was addressing the tax challenges of the digitalization of the economy. And you know that since 2017, late 17, when the US tax reform was advanced, the OECD has been mandated by the G20 to deliver a solution to address the remaining challenges of the international tax framework, and in particular, the challenges resulting from the digitalization of the economy. So I think that's where we are today. We've been able to develop quite intricate tax cooperation for the past 10 years. There has been progress. There has been a number of new rules, but there is still a lot of work to do to stabilize the system, as we have many stakeholders unhappy with the current system. And among the stakeholders, I would name European countries, developing countries, but also a number of US businesses criticizing the lack of tax certainty, which is due to the fact that countries have never invested enough in eliminating double taxation. But it's not only a tax administration issue, it's a tax policy issue. They have not invested more because they don't really trust this international tax system, including in the post-BEPS environment. So that's the landscape as I see it from my point of view. And then you have a virus disrupting the world. In a few weeks, end of December till early March, you have the virus spreading all over the world, an outbreak which results in countries deciding to close down their economy. So the COVID disruption is massive on the overall economy and is also massive on all the processes which were going on. What are the risks and opportunities, if we want to reflect on that in particular on our project? The first thing I would like to invite you to consider is the OECD response to the COVID-19 crisis. We published a number of documents from clarification on the interpretation of tax treaties. We think it was easy, that's why it's a secretariat document. It's been consulted more than, I think, 17,000 times, so it looks like it's a useful instrument. We have a request to work on transfer pricing, and that cannot be done by the secretariat only because it's less easy, so we need to get countries working together, and we have a project currently on that. We hope that governments will follow our advice to elaborate new rules through public consultation on this. We also provided responses to help tax administrations, and finally we provided to the G20 with a report with an economic analysis on what are the tax measures which should be taken during the crisis at the time of recovery and in the longer term. And you may have noticed that we advise against fiscal consolidation, to early fiscal consolidation, which could kill growth, as was the case in the aftermath of the 2008 crisis. On digital, because I know that's the topic which is of most interest to you all. And you may be disappointed, but I will not say more, and you will see why. On digital, there are a few things that we can see and witness. And here, if it's not necessarily my personal opinion, I report what I see happening. One, a number of countries consider that if the OECD has been saying we cannot ring fence the digital economy, we need to talk about the digitalization of the economy, and you know that I've been repeating that for the past 5 years, a number of countries say nice, but not true. Look, the digital economy has ring fenced itself. Just have a look at your street, you will see the retail shops closed, and you will see the delivery of whatever online sale platform. So the digital economy has ring-fenced itself. We're using a technology which is a good illustration of that. And a number of governments say, you know what, there is something that we need to deal, because these companies are thriving through the crisis pretty well. Some of them are doing extremely well. Even those depending on advertisement and business models are doing pretty well. And if you look at the numbers in Wall Street, you can see that it's been pretty successful. We have this phenomenon, ring fencing of the digital economy. Looks like it's happening for many governments, and two, they're doing well. And as a result, because we're spending that much money, we need to recover at some point. The first thing we need to do is to show that we recover money from the digital economy. And we know that the distribution is not right. That's government saying so because of Article 5, Article 7 of the tax treaties, which deprive us of the money we should collect. The second element that we can see is the fact that at the time of the bailout of most of corporate with the nationalization of wages through different mechanisms, furlough in the UK, chômage partiel in France, Kurzarbeit in Germany, or just cash payments in the US. And the US has probably been the most generous country in that area across the world. In all countries, you have a massive increase of public spending, and thus you have, I think, the thought that these companies that you're bailing out or supporting, you will not tolerate that in the future they don't pay you back the taxes you think they owe you. And if they locate part of their profits to low tax jurisdictions, you may consider that it's not right, and you may consider that you should do like the US, something like guilty. And we can see this narrative building. What does that tell us for our project? It's telling us that it's more relevant than ever. And interestingly, I would see also the impact of COVID on trade, international trade, as probably removing some teeth, pulling some teeth out of the mouth of Section 301, you know, the threat by the US to take sanctions against countries moving unilaterally. We can see Indonesia, India, Nigeria, Egypt joining France, the UK, Spain, Italy, Austria, Turkey, and I could name many others, saying, okay, we're going to move if we don't have a solution very quickly. So we have actually at some point thought, okay, COVID opens a completely new era, but no, we're back to the basics. And this could be found in the G20 communique of April. I read, and we, G20 finance ministers speaking, will continue to tackle the urgent global challenges we're facing, notably those related to the taxation and the digitalization of the economy. And that was also in the chair statement of the G7 written by the US. COVID has also impacted the negotiation. For 3 months now, we haven't been able to meet physically, and as effective as we can be with the team to prepare technical work, to advance the work, an international negotiation without physical meeting is not exactly the same. And I would say even more importantly, ministers had something else to do. They have other fish to fry. We all understand that. And we are just seeing them back to the topic. You may have noticed Minister Le Maire last week, the French finance minister, saying we're going to move ahead. We spoke recently with German finance minister, very much interested in that, saying we cannot fail. The Saudi presidency and the G20, which has the G20 presidency with Minister of Finance Al-Jadan, are very much involved. And we can see that politicians are turning back their attention to this, because I think no one wants a trade war at a time where the economy has been so badly disrupted. So I'm coming to my conclusion, and I will stop here, and you will see that you haven't learned much of news because things are in the making. What's next? First, and we announced it at the tax talks the other day, it was already decided to move the next inclusive framework meeting from July, 1st and 2nd of July, to October, because we cannot deliver in July. Can we deliver in October? And what can we deliver in October? This is what we are working on. I can tell you that the benefit of Zoom or other technologies, Teams or whatever, I don't want to name names, but the benefit is that you can call an international meeting in 1 or 2 hours notice, almost. With time difference, it's possible to call one for the day after. So we're able to work intensively, and we are working intensively. So we're going to have steering group meetings, and we maintain the inclusive framework in July for other purposes, BEPS implementation in particular, but we're able to work hard. And now that we have the politicians back in the loop, I think we will be able to make some progress on substance. The challenges there and the opportunities. Challenges, it is clear that the US has sent sometimes contradictory messages on Pillar 1. It cannot be ring-fenced to digital. It has to include more. We come up with a unified approach. And then yeah, but there is a problem with consumer facing, so it cannot really include consumer facing, or we should do a safe harbor, which clearly is hard to accept for other countries. So we can see here a contradiction which is not easy to solve, and we'll have to see how it is resolved in the coming months. For sure, we've made great progress technically. There are plenty of work which has been done on the revenue sourcing, on the scope, on the nexus, on the tax-based determination, the business line segmentation, and all these at some point will have to go for public consultations so that we can have input from the public, and we'll see whether October is realistic or also more time may be needed. But what seems for sure is that digital is still the focus, not to say the target by many countries, and having something tangible on digital, I think, would be highly expected. As regards Pillar 2, I think it's something like a no-brainer. The US has guilty, and assuming that guilty would be grandfathered, which we see as something quite obvious to happen, you have not necessarily many countries objecting to Pillar 2. We know that China is concerned with Pillar 2, but working. We know that tax havens or low tax jurisdictions are concerned, but you know, many things happen without them. So the question is, do they want to be in the process or actually just be the target of the process? That's a question for them. And we need to find the right balance with developing countries. But the narrative on Pillar 2, I would think, is stronger than ever, which makes me think that there is a fair chance to see something very significant in October on Pillar 2. I will stop here because I've run out of time, and apologies for being too long. And I'm happy to take a few questions, but the word of conclusion would be the work is going on. I think it's important that US business, I referred to in my introduction, which is powerful, which is listened to by the government, by the administration, whatever administration it is, has to understand that the world is moving and that the current circumstances are not conducive to multilateralism. That's another reason to support multilateralism and not to send the message that everything's delayed, should be delayed, and nothing will happen because otherwise countries will move unilaterally. And at a time of nationalism, of selfishness by the countries, you may be the victim of bad actions. So would we? You don't care. We care a bit about ourselves, but that doesn't matter. What matters is that we have good rules for a conducive tax environment, for growth, for tax certainty, and that will be achieved only if there is the perception that the balance is properly struck. Thank you very much.
Hey, Pascal, just a couple questions for you that have come in. One, which is just a basic question. One of the listeners would like you to explain the term BEPS that you use several times, just as the acronym.
Okay, that's a basic one, and I'm happy to respond. It's not too difficult, I think. I will make it. I think BEPS stands for base erosion and profit shifting. This is a project we launched in 2012. As I said, 2008 financial crisis, G20 takes over. They decide to tackle the so-called tax haven issue. We start with transparency, and we made great progress cracking down on bank secrecy. And then we said, but the tax haven issue has another dimension, which is the fact that legally it's tax avoidance, not tax evasion. Companies can locate their profits in low tax jurisdictions through different mechanisms, or because there are no international cooperation. And we came up with this idea to fight base erosion and profit shifting, thus the acronym BEPS, and that gave ground to an action plan of 15 measures, and then building what I call the inclusive framework, which is the body which monitors the implementation of the BEPS measures.
Thank you. Another question comes in from Michael Bidner, the Center for Fiscal Equity. He's asking if taxing corporations when things cross the taxing corporation income when the product hits or crosses the border, like we're talking in terms of digital taxes, isn't that much like a goods and service tax by another name?
It's a good question, and probably it's a way to tax services because these are services, and that brings us back to the question of how do you tax services. What's interesting, to give you a sense of why there is agreement to work on this now, why there was no agreement to work on restoring in Article 14 of the Model Tax Treaty, which is about taxation of services, or why OECD countries usually are opposed to see gross taxation of services. The reason why there is this move and this work is, one, because I mean the digitalization is something serious, massive, and long-standing. And it questions the existing rules. The existing rules dates back to 1926-28, at the time where you had really a brick and mortar economy with limited international interactions. Would we write the same rules, in particular for the permanent establishment, which means when you start having a taxable presence in a country the same way today as we did more than 1 century ago? The answer is no, we would not. I think we would consider there is a taxable presence, even though there may not be a physical presence. And that's why there is this work. The second one, which is more geopolitical one, is European countries, which have been like the US, capital exporting countries, and therefore advocates of residence taxation. Income should be taxed in the country of residence of multinational companies. European countries have discovered what it takes to be a developing country, a digital developing country. They can see US businesses or Chinese businesses investing massively, having brains, having algorithms, having capital. And these countries see a lot of profit derived from their territories. Sometimes they confuse profit and turnover, but still there is profit, and we can see it in the balance sheet of all these tech companies. They see all these profits deriving from their territory, and they say, we don't have anything. Nothing is paid to us, so we need to see something. It's a bit the same as what developing countries could see on other services or other ways of investing. And that's why they suddenly said we need to address that. But the US itself in 2017-18 recognized that there was an issue and that market jurisdictions probably didn't get enough on marketing intangible and so, and that's why the US supported one approach, which has been more or less the matrix for what we have called the unified approach, which is the current approach for Pillar 1 discussed by the inclusive framework.
One other question came in about the data that you're using to look at economic impact analyses. Could that data be made available or open sourced?
It should. The answer is yes, it should, but the same answer is no, it is not for the time being. Why so? I serve a board, if you want, the comparison with a foundation or research center, but my board is made of sovereign member states, and the sovereign member states have very, very strong feelings about that. They don't want their data, which has been built based on public data, I mean, sources, Orbis and other instruments like that, but also by country reporting, aggregated, anonymized. We are using this data, and the member states are extremely nervous about that. And they have delayed the time where we can go public. So personally, I would be a strong advocate of making this public good. It's not yet the case, but we hope it's going to come soon. When exactly, I don't know, but it will be coming soon.
And then one last question, and this is been asked a couple of times. A couple of academics, several academics have proposed a Pillar 3, a global excess profits tax on industries that have gotten outsized financial rewards in the COVID-19 pandemic time. Is that possible to consider a Pillar 3 that would look at global excess profits? I
love what academics do. I do, but they're here to, I mean, you know, tease the the governments and animate the intellectual debate, but the answer is no, it's not on the table. But I like the idea of a pillar 3, and by the way, I floated it internally for some time, but not at all with that. What I think, and this was included in the report we presented to the G20, is the fact that developing countries said rightfully that they have not benefited much from BEPS, and BEPS was not an agenda for developing countries. It was not against the interest of developing countries. It favors actually the interest of developing countries by protecting them from too aggressive base erosion and profit shifting. But it is true that very often the rules are too sophisticated for tax administrations which lack capacity. It's also true that the debate on the reallocation of taxing right, which is now happening on the digital debate, this debate has not probably taken into account enough the views of developing countries. So if there were to be a pillar 3, it would be on developing rules, BEPS for developing countries, if you want, and developing countries in narrow meaning, which means the least developed countries, the African countries, not India or China, which sometimes are classified by different organizations as developing countries. But the small developing countries, I think, would need something to be still part of the international consensus and adhere wholeheartedly to the institutions we've built. And there, they actually may need a pillar 3.
Well, Pascal, thank you so much for spending time with us today. I think it was an incredibly valuable and enlightening session. So I very much appreciate it and wish you all the best in your endeavors and hope that you can come to some kind of a resolution in October. So thank you very much.
Thank you. Thank you all.
And with that, let me turn things over to our first panel today. We have Professor Ed Maydew, who will be moderating the panel. Professor Maydew is the director of the University of North Carolina Tax Center. So Ed, welcome.
Thanks, Mark. And welcome to the first panel, which is how big a problem is income shifting. My name's Ed Maydew, and I'll be moderating the panel. We have a great set of panelists for you today, participants. They are all actively researching income shifting. They all have impressive biographies and CVs. How impressive, you ask? Well, if I read their accomplishments, it would use up all our time. So instead, I'll refer you to their biographies, which are on the Tax Policy Center webpage, and also to their university homepages for their CVs. Our panelists are Kim Klossing from Reed College, Scott Dyring from Duke, Leslie Robinson from Dartmouth, and Gabrielle Zeckman from UC Berkeley. And this panel is going to have 3 parts. So in the first part, each panelist will speak for 5 to 7 minutes, uninterrupted. And then we will come back together as a panel for some discussion. And then towards the end, we will have Q&A from the audience for about roughly 10 to 15 minutes. And at any time, you can submit your questions via the question and answer button at the bottom of your screen. And those questions will come into us as moderators, and we will ask those, as they come in to the Q&A session. When you do submit a question, please include your affiliation and to whom the question is addressed, which of the panelists. And with that, I will turn it over to our first speaker, Kim.
Thank you. I'm just waiting for the slides to come up, and then I will begin. So thank you, Ed, and thank you for moderating this panel. I'm so happy to be part of this conversation with all the people that TPC and UNC brought together on this really important topic. So the question our panel was directed to address was the overall size of the profit shifting problem. And my read of the evidence makes 2 facts very clear. First, there is abundant evidence that this is a very large problem. The exact magnitude of the problem depends on the data source used, but it is clear that the problem is quite large. Second, the data show that havens are at the center of the problem. For example, in the 2017 data provided by US multinationals to the IRS as part of their country-by-country reports, we see about 4.2 trillion in foreign income. That excludes the stateless income. Of that 4.2 trillion, about 3 trillion is in havens, which I define as designated countries with effective tax rates below 10%, again, excluding the stateless income. So the key takeaway here is that havens are very important. Now, some researchers have found a smaller problem, but most of those researchers are relying on Orbis or CompuStat data, and these sources do not show us any meaningful detail on income reported in tax havens. Given how important havens are in this story and the nonlinear response of companies to the lowest tax rate countries, missing havens is unfortunately missing most of the problem. Parenthetically, this is not meant to detract from Scott and Kevin's really nice paper that's going to be coming next. They take a really creative approach to looking at the CompuStat data. But in general, in these data, we just simply can't see the haven income. Fortunately, there are other data sources that do show haven income. My approach has been to use information from several of these series, recognizing that each series has strengths and weaknesses. I describe these series in great detail in my paper in Appendix A of the longer profit shifting paper that's on the conference website. The BEA data show us 7 of the big havens, and the new US country by country data from IRS Form 8975, as well as other IRS informational reporting, shows many more havens than even the BEA data, including some additional small islands with accumulated earnings that are in the hundreds of billions of dollars, like Jersey. The BEA data have lately been somewhat controversial, so let me say a few words about those series. BEA has 3 different series, one of which has a known double counting problem, a problem we've known about actually for over a decade. 2 other BEA series do not have that double counting problem. A recent paper by Bluin and Robinson has argued you can make an adjustment to the double counted series to get a better accounting measure of profit using the equity method of accounting. Their adjusted series is similar to the BEA profit type return series. According to the BEA and JCT economists, though, who best know these data, that adjustment may show important accounting concepts, but it doesn't necessarily show us where the income actually is reported for tax purposes. In particular, that adjusted series may miss income that is shifted among foreign countries. And as a consequence, there will be too little income in havens if we rely on those data. So the following table shows the 4 series that I use in my paper on profit shifting that's on the website, and it illustrates the puzzles of this adjusted series. All the series in this table are for 2017, and here you can compare the adjusted series to the BEA direct investment series, which is not adjusted except to add back the tax. And you can also see the 2 country by country series in this table. The totals in 2017 are similar, and we're looking at all the data on a comparable sort of before tax basis. The country by country data have the largest reach, and the positive profit series of those data have the largest total income, but that series excludes companies with losses. Interestingly, the other 3 series may overestimate the effective tax rate because they're including companies with losses in the sample. If you look at the distribution of profits in the big 7 havens in this table, you'll see that there is less income in the big havens in the adjusted series than in the other series. And there are also some interesting puzzles there. For example, in the case of Bermuda, the Bluin and Robinson method generates negative 10 billion in 2017, with negative income in 2016 and very small amounts in other years. Yet other series show, I think we're still back on the other slide. Back 2 now. Yeah, there we go. Yet other series show tens of billions of income in Bermuda, and the US multinationals have told the IRS, and this is in the final column here, that in their country by country reports, that as of 2017, they've accumulated over $630 billion in Bermuda. So we're pretty sure that income in Bermuda should be positive. So my approach in recent work, and that's the next slide, is to use 4 of these data series and 3 different methods to look at possible magnitudes of revenue loss due to the profit shifting of US multinational companies. And this analysis is for 2017 using US tax rates as of 2017 before the recent tax cuts. The paper has all the details about these estimation methods, as well as the underlying data, but unfortunately I don't have time to go into those details now. But you do see quite a range of estimates, and in the paper I describe why I prefer the bottom row method and why I prefer the bolded series. But but even using the adjusted series that emits some of the foreign to foreign profit shifting, and even if you use the most conservative method, you still get a $60 billion revenue loss, which is that number in the second column. And that's equivalent to about 20% of the US corporate income tax base in 2017. Finally, I'll leave you with two pictures. In the first, we see the distribution of foreign profits of US multinational companies in those countries where they've clearly stated a location for their taxable profits. The dark blue bars show you the reported profits, and the light blue bars, the part of those profits that I estimate are actually shifted profits. You see that most profits and almost all of the shifted profits are in haven countries. Very few profits are in countries with tax rates above the new US tax rate of 21%. And that's the final set of columns that you see there. And in the final picture, we look at how the distribution of US multinational profits across foreign countries has changed over the present century. The share of profits in the big 7 havens has risen steeply, but it's leveled off in recent years. Perhaps that leveling off is due to the BEPS measures. But with 2 years of data since the Tax Cuts and Jobs Act, there's no evidence of a reduction of profit shifting due to that law, so far at least. So while we know the use of havens is no longer increasing substantially, it's also not getting smaller. So whether we view that as success really depends on the counterfactual. So I will leave it at that, and I'm really looking forward to our conversation today. Thank you.
Okay. All right, I think I'm next. It looks like I'm up and the slides are up. And let me just echo Kim's comments and say thank you to the organizers for this opportunity, and also echo something that she said, which is I think most people would agree, and I'm one of those people, that profit shifting is indeed a big problem. And what's being disputed here is not whether or not it's big, it's just a question of how big. And so I, as an accountant, have spent most of my time thinking about the problem using financial accounting data, primarily of US publicly traded firms. And this data primarily comes from CompuStat. And you know, Kim pointed out that this data has some weaknesses, which is true, but it also has some advantages. And when you use the publicly available data for US firms in CompuStat, one advantage is you do have a picture of all of the firm's income. What you don't have is an understanding of exactly where that income is located beyond the fact that it might be in the US or it might be abroad, but you don't know which countries. But even looking at that, there are some ways that you can, with those limitations, there are some insights that can be gained. So the figure you can see on the screen is a very simple figure where I aggregated all of the profits of of US multinationals. And what you can see in the middle line there is in 2018, there was about 628 billion of foreign profits, pre-tax foreign income. And I note here on the slide that that's at some level an upper bound of income shifting for this sample. And I call it an upper bound because if all of those earnings were located in, say, a tax haven, that's the most that could be there. But when you look at another series, which you can get from the publicly available information, we find also that these same companies have paid about 126 billion in tax to foreign governments, or a rate of about 20%. Sometimes though, the magnitudes of these numbers are a little tricky to look at, so it makes sense, I think, to look at proportions. So Dominic, if you can slip to the next slide. On this next slide, what you'll see is foreign earnings as a percentage of total income. And you see this hovers something about 40 and 50%, increasing over time with some spikes in say 2008 and 2001. And I think that those spikes are driven not by unusually high foreign income, but by unusually low domestic income because of recessions that took place in those years. But the reason that this is important to note is that in some of the research that we look at, where we think about what fraction of a firm's profits are located in tax havens, this data would suggest that in 2018, the highest fraction that would be even conceivable would be something like 54% of the firm's profits were in tax havens. But that would only be the case if all of their foreign profits were recorded in tax havens. Dominic, take me to the next slide, if you will. And this next slide shows that it's unlikely that all of those earnings are located in tax havens because these firms are paying taxes to foreign governments. And so if one aggregates foreign earnings and divides by, if one aggregates foreign taxes paid and divides by foreign earnings, the effective tax rate of these companies has been declining over time from about 35% in about 1988 to roughly 20% in 2018. And this corresponds at least roughly with the decline in statutory tax rates of OECD countries, and suggests that on average firms are paying taxes. Now clearly this doesn't mean that some firms are shifting large amounts of profits to tax havens and paying very low taxes, but at least many firms are paying significant amounts of taxes to foreign governments. Take me to the next slide, please. And in this last slide that I'll talk about, I'll just point out a couple of things from a recent working paper that I'm involved in with Robert Hills at Penn State and Kevin Markle at the University of Iowa. And what we do in this paper is we use the financial accounting data along with disclosures that the firms are required to make with regard to the location of their foreign operations. And we infer the amount of income that was taxed by the governments that they operate in. And then we take the difference between that amount and the total amount of foreign income to estimate the amount of foreign earnings that essentially went untaxed by any foreign government. And in the first row of the table, you can see that these numbers are large, that a large amount of earnings went essentially untaxed or taxed at a very low rate by these countries. But one of the fascinating things that we're able to do with the CompuStat data is we can then look firm by firm and year by year to see which specific firms are those that account for the largest amount of these untaxed profits. And in the figure below, what you see is growth in profits that are untaxed by foreign governments. But you also see that about half of those profits come from only 10 large firms. And if you look at a list of those firms, they would be the firms that you would most likely suspect, the ones that show up in the headlines of the newspapers. And so in conclusion, I guess I would just note that I think our work, and I think everybody on this panel's work, would say that the problem is large, and exactly how large is something that is difficult to pin down. And it's great that we have a lot of estimates coming from a lot of different methodologies and different data sources so that we can increase our understanding of the issues. And with that, I'll leave it to the next speaker. You can skip this. People can look at it later. Thanks.
Hi, good morning. Thank you to the organizers for asking me to join the conversation. And I would like to start out by putting my remarks and expertise with regard to the panel topic into context for everyone. So my background and training is in financial accounting and taxation. And I've always been interested in studying the intersection of these two issues in the multinational firm context. In 2007, I made the decision to gain access to the BEA microdata through their special sworn employee program because I knew that learning about the country's specific activities of multinationals would enhance my work and understanding of these firms. As Scott mentioned, in CompuStat, you don't know exactly where the income is reported, And so gaining access to the BEA data has really enhanced my research in the income shifting space. The objective of my current work is not to provide an estimate of the magnitude of profit shifting. I would in fact say I'm less interested in whether the answer is big or small, and I'm more interested in whether the answer was arrived at from a correct and sound analysis. By that, I mean I'm interested in how researchers are using and interpreting the data, which is often derived from financial accounting for bets analysis. More importantly, I'm concerned about our inferences with respect to the change in BEPS over time from the TCJA, and I'll explain that later when I look at an example. So I would call myself an interested consumer of this work that estimates fiscal effects, and indeed most of the two of the most prolific authors in this area are on this panel, and I have long followed their important work. For several years, somewhat superficially, I've read these papers always thinking, wow, those estimates seem really big. So I became something more than just an interested consumer when two international tax scholars at a conference whispered to me during the conference, in fact, while Kim was presenting her work. And they just simply asked the question, do US multinationals really report that much income in tax havens? That sounds implausible. I decided then that it was time to really dig into these papers more carefully. And I sat down with my co-author, Jennifer Bluen, and we replicated some of this work. And as you all know, reading a paper and replicating a paper are two different things, and replication certainly helps you understand better. So that's just some context for my remaining remarks. So the first slide there is, let me just show you some statements that have been made about the various data sources that are out there. And you can think about this as introducing a significant dilemma for BEPS research. So apparently all of these data sources, including the BEA, US tax data, 5471s, country by country data, are all declared as, I see words like sophisticated, reliable, and accurate, and CompuStat and Orbis are nearly useless. So there have really definitely been some stakes put, I'm sure that warms your heart, Scott, to see that on the slide. There have definitely put some stakes in the sand with respect to what data sources that one should use. So let me go through some numbers here, and this sort of implies that if all of these sources are great, then they must tell us approximately the same thing. So here are some numbers. You can see here that from the BEA data, there's a number of different measures you can choose from. And so what I'm trying to illustrate here with this slide is that the amount of income that you would think was earned abroad by all US M&Es in 2012 can be very, very different depending on the measure that you choose. We can see here a spread from 438 billion to 1.2 trillion in a single year. It has to matter when you look at that what measure you choose. The two that are in red are the two that appear in Clausing 2016, which is the paper that was last published with US fiscal effects. It was downloaded 2,300 times on SSRN, and the abstract views were about 12,000 times, right around the time when we were debating reform to our international tax system. These fiscal effects estimates are significantly overstated, as we show in Bluen and Robinson, and this seems to me to be a problem. Next slide. Things get even uglier when you start to compare income earned in various countries as opposed to an aggregate. And so this is just an illustration of how much income you might think was earned in the Netherlands. Again, the two that were used by Clausing 2016 are the first one and the third one. And so things just get uglier when you start comparing by countries. Next slide. And all of that adds up to then talking about these 7 havens. If you just look at the proportion of income earned in havens over time, you would get wildly different percentages. Now, Bluen and Robinson 2020 that I referred to on the slide and the frequently asked question on the BEA website are meant to address misuse of the BEA data. There does seem to be some issues with respect to the people at the BEA that Kim is speaking with versus the people that we are speaking with, because in response to our paper, the BEA published a frequently asked question to clarify the specific issues that we raised in our paper to help future researchers not misuse the BEA data. Next slide. So I wanted to just quickly go through this example. This is mostly what Bluen and Robinson is about. The ownership structures are a significant reason you see differences across data sources with respect to how much income is earned in each country. This is a simple example where you have 3 US MNEs always earning the same amount of money in France, $230, and $100 in the Netherlands. All I'm going to do from left to right is change the ownership structure. In the middle, there's going to be a 70% ownership link between Netherlands and France and a 30% between the US and France. All of a sudden now you can see that the Dutch income in the Netherlands grew from 100 to 261. That's because the 70% of the French income is now reported in the Netherlands. When you move over to the right again, the problem simply gets worse. Now all of the income is reported in the Netherlands that was earned in France, and it's also reported in France as well. Now Kim stated that DII was her preferred measure of income to use to study income shifting. That's going to mean that on the left, DII is going to have $100 in the Netherlands, $230 in France, and on the right it'll have $330 in the Netherlands. There's no reason that I can come up with that would be a useful way to study BEPS. Furthermore, if a firm starts to unravel its ownership structure in response to the TCJA, which I've been told that firms will do, you're going to have the data change on you, even though there's no difference in income shifting. And then final slide. The final slide is in Bluen Robinson 2020, and this is similar to the slide that Kim showed you, except I rewind 1 year to 2016. So first of all, 2017 for BEA data is preliminary. The last time Kim used preliminary data from the BEA in 2012, when the revised data came out, there were about $8 billion more income in Bermuda than in the preliminary data. So I don't think it's useful to be drawing inferences from preliminary BEA data. So that's just a best practice for those of you out there that will use BEA data in the future. Furthermore, you can see that 5471 data, which has been declared a very useful data source to study profit shifting, has 84 billion in Bermuda, but her preferred data source has 41 billion in Bermuda. I'm not sure why that's not a problem. You also see negative income in 2016 in the CBC data of 2139 in Luxembourg and 6204 in Switzerland. So having small negative profits in different income series is not something that's unique to the BEA data with respect to tax havens. I'm also not sure why that's not a problem. So in summary, what I would just like to send as my overall message is that I think it would be useful with respect to best practices if future work in BEPS could choose a data set and an income measure based on how that income is measured and not on whether it shows high or low profits in a particular jurisdiction. Thank you.
Hello, everybody. Thank you so much for having me. It's a pleasure to be here virtually with you today. I'd like to talk about recent work with my co-authors Ludwig Wehr and Thomas Torslov, in which we try to estimate the scale of global profit shifting. And the starting point is that perhaps the most striking development in tax policy throughout the world over the last few decades has been the decline in corporate income tax rates. So between 1985 and 2018, the global average statutory corporate tax rate has fallen by about half, from 49% to 24%. One reason for this decline is international tax competition. By cutting their tax rates, countries can attract capital and profits from abroad. But despite the prominence of tax competition in both the academic literature and the public debate, we do not currently have comprehensive estimates of how much profit each country loses or attracts because of differences in corporate tax rates. There are excellent data on US multinationals, which have been used extensively to study the location and tax optimization choices of US firms. But until recently, there was no similar data covering the multinationals of other countries. Our paper attempts to fill this gap by drawing on new data, because in recent years, the statistical institutes of most of the world's developed countries, including the major tax havens, have started releasing new macroeconomic statistics, which are known as foreign affiliate statistics or activities of multinational enterprise statistics. These statistics record the wages and profits of foreign firms, defined as firms more than 50% owned by foreign shareholders, so typically subsidiaries of foreign multinationals. And by combining these new data with existing national accounts aggregates, which cover all firms in a given country, we can estimate the profits made and wages paid in each country by local firms and foreign firms separately. By doing that, this makes it possible to provide a comprehensive view of where multinational companies book their profits today, and in particular to estimate the size of global profit shifting. So by using this new data, we document a quite simple but striking fact, which is that foreign firms are systematically more profitable than local firms in low tax countries, while the opposite is true in high tax countries. So more precisely, local firms, that is firms that are not part of a foreign multinational group, for these firms, the ratio of pre-tax profits to wages is typically around 30%, 40% in both high tax and low tax countries. So for any dollar of wage paid, local firms throughout the world, in tax havens and non-haven countries, make about 30-40 cents in profit. But for foreign firms, the ratio of pre-tax profits to wages is an order of magnitude higher than 30%, 40% in low tax countries. While for foreign firms in high tax countries, this ratio is lower than 30%, 40%. So take Ireland, for example, very striking example. In Ireland, foreign firms have a ratio of profits to wages of 800%. So affiliates of foreign multinationals in Ireland, for any dollar of wage or any euro of wage that they pay, they record 8 euros in pre-tax profits. In the UK, by contrast, foreign firms have a profits to wage ratio of only 26%. So for any pound of wage paid, they book 26 cents in profit. This global macro data does show a large redistribution of profits within divisions of multinational companies away from high tax countries and towards low tax places. Using this differential profitability of foreign firms in high tax versus low tax countries, and using new balance of payments data that were recently published by tax havens, along with my co-authors, we developed a methodology to estimate the amount of profit shifted into each tax haven and the profit loss for individual high tax countries. Globally, we find that close to 40% of multinational profits are shifted to tax havens. We define multinational profits as the profits made by multinational companies outside of the country where their parent is located. Think of the profits made by Apple outside of the US, or profits made by BMW outside of Germany. So our findings that about 40% of that total at the global level is shifted to tax havens globally. And these results have a number of implications. They suggest that the headline economic indicators like GDP, trade balances, corporate labor and capital shares of a number of countries are distorted, because the flip side of the profits shifted to tax havens is that output net exports and profits recorded in non-haven countries are too low. One of the things we do in this research is to provide a new database of corrected macroeconomic statistics for OECD countries and the largest economies. And second, and I end with that, our results can be used to quantify the tax revenues that individual countries could gain under different corporate tax reform scenarios. We consider one such scenario, the taxation of shifted profits by source countries, and we find that corporate tax receipts could increase by about 15–20% in the US and in a number of European countries compared to today. But in the future, our data could be used to quantify the revenue implications of more fundamental tax reforms, such as the use of a formulary apportionment system, for instance, or destination-based corporate cash flow tax. We are updating our database every year when these new statistics are released. We have now estimates for 2017, all the data, the computer code, the program, the detailed technical appendices are online on missingprofits.world, and so all of that can be replicated, improved, and extended. Our hope is that this database will make it possible for researchers and policymakers to track the effects of ongoing policy effort aimed at reducing profit shifting, such as, for instance, the OECD-based erosion and profit shifting initiative, or the effect of the 2017 US tax reform. So let me just conclude by saying that I encourage you to go on the website missingprofits.world, and I very much look forward to the discussion. Thank you very much.
Great. So panelists, we can join as a group now. So we have some questions we have in advance, and then we have questions coming in from the audience. So I might just mix it up a little bit with both. Why don't we start with you, Gabrielle? So we've talked a lot about income shifting, and it might be useful to think about the terminology of income shifting. I think this follows from some of your work. When we think about the construct of income shifting as apart from the measurement, how do we think about the construct? How do we think about that?
You mean how should we define conceptually income shifting? You know, that's a good question. You know, and I'm not sure there is one very one unique or very clear answer. The way I think about that in my work is the following way. I think it's useful to imagine how the world would look like if all countries had the same effective corporate tax rates. So imagine that tomorrow there is a big international conference and all countries decide to apply the same corporate tax rate and to define the tax base in the same way, okay? And let's imagine that global profits and the global capital stock remain constant. In such a world, how the geography of profit would change compared to today is what I'm interested in. I think is a meaningful and definition of income shifting. So if there was a single tax rate, there would be less profit booked in Ireland, less profit booked in Bermuda, more profit in the US, more profit in Germany. And the difference between the profit in this counterfactual world and what we observe today is income shifting.
Excellent. Other panelists? Thoughts on that? Scott, Kim, Leslie?
I liked Gabrielle's definition. Yeah, I think that's a good one.
Okay, Scott, Leslie. Okay. Leslie, question for you. So researchers have preferences for using different data sources to study income shifting. What would make a data source good or desirable to study income shifting if you had sort of like your ideal data source?
That's a very, very good question. Well, I think first of all, you would want it to be reliable. So you would want to understand the regulatory environment under which it was produced and any penalties that might be involved with non-compliance and things like that. I think it's just important that it's right, which is, you know, for all of its weaknesses in CompuStat, I think it's one of the strongest data sources in terms of that, because these are from audited, consolidated financial statements, and it's very hard to believe that there was misreporting. When it comes down to sort of Treasury data and C/CR data and BEA data, you know, the 5471, this is an information return. You know, I don't know, is that reliable? Is there compliance with that form? I don't know the answer to that. C/CR is the same. Is there compliance with that? It's only been around a couple of years. I was just on a public consultation meeting, so I think another feature of data that you should be interested in, especially if you're going to look across countries, is comparability. The data needs to be comparable and consistently measured. There was a public consultation meeting last week on C/CR with some significant concerns that those data were not reliably or consistently reported across countries, that there was double counting in the data, that countries were doing things differently. The UK, in fact, has refused to release its aggregate data because they're concerned about consistency. So I would say accuracy and consistency are two important features. And then just finally, as Bluen and Robinson 2020 point out, you have to know how your data source accounts for indirectly owned affiliates, because that can put income in the wrong place, and it can put too much income in the wrong place. And so I think that you have to understand that. And I think the BEA data is the only data set where we do understand that, because the form instructions haven't changed since 1982. And if firms aren't reporting equity income in that fashion, then we have bigger problems, because that means our national statistics are wrong.
Okay, other panelists, thoughts on ideal data sources?
Yeah, I would add to that. I think that there are some interesting things you can do with the accounting data that shows up in CompuStat and Orbis, but one of the difficulties is we really don't have the country by country breakdown. So I think both the BEA and the tax data are somewhat more illuminating if you really care about where the havens are. And there are pluses and minuses with those different series. And my Appendix A kind of goes through those pluses and minuses. I think some of them are good lower bound series, which is the category I would put the adjusted one in that Bluen and Robinson put together. And some shouldn't be used. A couple of the ones that were highlighted in red, for instance, that I've used in past work, I explicitly noted were either upper bounds that included double counting, or there was one with an adjustment that ended up being changed, right? So the ones that I have in the 2020 data, those 2020 papers, those 4 series, I think are all useful ones. They all show haven income, which I think is important. They all have strengths and weaknesses, but they're all collected in a way that I think is reasonable. The nice thing about the country by country data, while I think they do need to be clearer with the instructions, and they're working on that in the years ahead. 2017, we really only have one country and 1 year for it, but it does show an awful lot of things that the other data have failed to illuminate. So I didn't know, for instance, that there were $460 billion of accumulated earnings in Jersey. And I couldn't have seen that in the BEA data because they're not broken out. But a lot of those places like Jersey and Isle of Man, you know, these obscure little havens actually can be kind of important. So I think as we get more and more data, we're going to get hopefully a clearer light about that range of estimates. But you know, I think it's important to keep looking at each data set with good scrutiny.
Excellent. We also have questions coming in from the audience, so I think I might mix these up a little bit. So one question we have, I'll put this to Scott first, but really anyone can chime in. It's just for the general group. To what extent this is from Jeff Lonsdale of Logical Formulas. To what extent will the proliferation of net operating losses scramble the ability to do meaningful profit shifting analysis? And I assume that's in the sort of current environment where we can expect a lot of NOLs. Scott, do you want to take that first? Or?
Yeah, sure, I'll take it. I mean, it's related, I think, a little bit to what we were just discussing, in the sense that your data source, I think, depends on the research question you're asking. And in some situations, a macro data series might do a better job of answering a specific question. And in some situations, a micro series might do a better job. And net operating losses could affect micro series in a way that's different from a macro series. And I think it's always a challenge because net operating losses change the amount of tax that is paid in a way that is expected by governments, right? They grant these provisions. And if firms have very large net operating losses that they can use to shield their income from tax, they don't have the same incentives to shift their income into a tax haven. They'll be shielded by net operating losses. So I think it creates two problems. One is the data itself will be a little bit more difficult to interpret. And the second problem is the incentives that firms have to shift income could be altered by the fact that these net operating losses are very large and might shield their income without the need for income shifting.
Other panelists, thoughts on that, or?
I was just going to add that I really do, you know, Scott's devoted the bulk of his career to helping us understand BEPS by looking at CompuStat data. And I think that with respect to the losses, I think CompuStat data is really going to help us out there too, more so than these other data series, which don't get into a lot of detail with respect to sort of NOLs and deferred taxes and things like that. And I will also echo, you know, Kim's comment about having the detailed country data is important. For instance, you know, in the BEA data, you can see this Bermuda income disappearing over time. It slowly notches down from 2014 to 2015. But at the same time, UK income in the BEA data takes off. And that's because Jersey's in the UK for BEA reporting. So we also know that Apple moved its Bermuda income to Jersey. So could that all just be that Apple's income disappeared from Bermuda and appeared in the UK in the BEA data? So I think that this conversation just does illustrate that everyone can contribute to this conversation because different data sources do have different strengths and weaknesses. But I just wanted to highlight that one as another one since we were talking about Jersey. I think that the income is moved from Bermuda to Jersey. You just can't see it in the BEA.
Excellent. We have actually quite a few questions coming in too. So there's a question for Gabrielle, addressed to Gabrielle from Michael Binder. Would a global asset value added tax, where the money is even more mobile, have more utility ignoring corporate assets and focusing on who owns it? Thoughts on that, Gabrielle?
Yeah, no, that's a good question. There are many, obviously, proposals out there to reform global corporate taxation. One thing which I think doesn't get enough discussion and I'd like to mention is the very simple idea that for each multinational company, the tax authority in the US or in France or in Germany can compute that firm's tax deficit. You know, the notion of tax deficit, I think, is important. What is the tax deficit of a company is the difference between what this company would have to pay in taxes if it was subject to an effective corporate tax rate of, let's say, 25% in each of the country where it operates, and what this firm actually pays. So for each firm, you can compute the tax deficit. Google, for instance, in 2019 booked $20 billion in revenue in Bermuda, but the tax rate is 0%. Obviously, there's going to be a tax deficit there. So each country can compute the tax deficit of each firm and then say, we are going to collect part of that tax deficit. So for instance, if a company like Apple has a global tax deficit of $10 billion and makes 10% of its sales in Germany, Germany could say, we're going to collect 10% of Apple's global tax deficit. You know, in exchange for the right to operate in Germany, we want to make sure that you pay a minimum amount of tax globally and on a country-by-country basis. And that's the idea that I defend. That's an idea that we present in our book with Emmanuel says, The Triumph of Injustice. And I like it. I like that idea because it's very simple to implement. Now that we have country-by-country reports, any tax authority can compute the tax deficit of any company and then unilaterally say, we're going to collect part of that tax deficit.
Excellent. We have a question coming in for Leslie, but I think probably everyone's going to have thoughts on this. There's a question from David Morse. If the measurement of the audited consolidated financial reporting is best, would you suggest that policymakers should consider making that data more transparent by requiring country-by-country reporting or even book tax conformity? So two different aspects to that.
Yeah, I mean, two parts to my answer. One part is, I think that CompuStat data is a useful benchmark for thinking about what the aggregate data should tell you. So in one of my slides, I had showed that the BEA adjusted measure from Bluen and Robinson 2020 correlated well with the aggregate foreign income from CompuStat. And in fact, one of the first things I did in 2007, along with my co-author Jennifer Bluen, we went to see the BEA accountants. And it was funny, they said, nobody ever comes to see us. Why do you want to see us? And we wanted to understand how these data should relate to CompuStat. So just at a broad level, I think my first answer is if the aggregate income that you think is happening abroad for a US multinational in particular does not correlate well with CompuStat, something's wrong. That should tip you off. Should the CompuStat then, the specific question that was asked was, should the CompuStat then be more disaggregated? And that is a debate that, I'm sure that Scott has opinions on this as well. That's a debate that continues to ensue. I think that it should. I think that the data should be more disaggregated. I think investors want it. I think that investors should be able to get more disaggregated data. I don't know that I would go to the level of asking public country-by-country reporting to be public, but I do think financial statement disclosures could be more specific as opposed to just foreign or Europe or Asia, which is kind of how we do it now.
Yeah, I'll comment too, if that's okay, Ed. And I'll maybe specifically comment on the last part of that, which was, should we have book tax conformity? And my opinion is that that's a pretty bad idea for the following reason. Financial accounting is designed for a specific purpose, which is to provide investors with information that is useful in determining how to allocate their scarce resources. And tax accounting is designed with different purpose, one of which is to collect revenue, another of which is to encourage or discourage certain behaviors, and another of which is to redistribute wealth. And the reason we have two systems in every single country is because they are attempting to achieve different objectives. And if we force them to conform, markets would demand pro forma accounting that would allow them to make the investment decisions that are necessary. So I think conforming is probably not the greatest solution to the problem. One possible solution would be to require greater disclosure of what's happening in the tax world so that investors could compare in publicly available information within a firm what's happening in terms of the discrepancies between financial accounting and tax accounting. And in general, I would be in favor of more disclosure, but there's lots of trade-offs, and accountants debate disclosure extensively. And it's not always as clear and as simple as one might think.
Yeah, Ed, I want to add one thing to what Scott said that made me think about it when he was talking, is that I think there is some confusion as well about country-by-country reporting being tax data. So I know, Kim, when you were talking, you mentioned that, that some of the BEA data series were flawed because it was where income was booked for accounting purposes, not where it was taxed. I think that's how you worded it. Country-by-country reporting is financial accounting data. It's not where the income was taxed. It's not from a tax return. And so in terms of book tax conformity, I think an underlying assumption when you use all of these data sets is that financial accounting data is a good proxy for where income was taxed, but I don't know of any data source that would tell us precisely which jurisdiction a US multinational or any multinational firm's income was actually taxed in.
Yeah, let me say a few words on that. So and relate it back to that last question. I mean, I think having more disclosure of the accounting data would be great. I am in agreement with that. We have seen a couple companies like Shell put out accounting data that shows the country by country voluntarily. And I think the more light you can shed on this, the more important, you know, and useful it would be, because companies will be incentivized when thinking about their reputations to also think about where they're putting their income. And so I think that's a nice mechanism that we have there. Another thing to note is that a few companies are likely to be particularly important in this space. And one of the reasons why I think the studies that have relied on firm level data have often found small effects is that they're looking at thousands and thousands of companies. And we may think that the tail of the distribution, the really big shifters, the really big companies are behaving differently from the average company that's being used to sort of generate those benchmark elasticities. So I think looking at the role of really big companies here is important. In terms of the conformity about book versus tax income, I think one of the reasons that candidates and others have put forward proposals to start taxing book income is because they've lacked the political will to fix the tax base. You know, and my preferred solution would be to, you know, muster up the political will to fix the tax base, not try to start taxing an accounting concept. You know, I do think if you could work with, say, a Treasury co-author who had access to tax data, that would be wonderful and probably the absolute best source of data that you can have. Just because, you know, something's being put on a tax form, that doesn't mean that's where your taxable income is. And there's some really nice work by Bilica that shows that there's many, many instances of companies in the UK having zero taxable income, but having positive accounting income. So those concepts are different. But I think mustering up the will to fix the tax base would be a much better idea than fixing conformity, because the corporate tax is, you know, really important tool for taxing capital income. And one of the questioners was asking, you know, why do we even need a corporate tax? We could just tax this on the individual level. But one important thing to remember is that about 70% of US equity income goes untaxed by the US government at the individual level. So the corporate tax is really the only mechanism for taxing that part of capital income.
Excellent. And we're bringing up issues. We could have a whole nother discussion hopefully next year about some of these things, which is cool. So let's try to wrap this up with one last question for everybody. And that would be, so researchers have been studying income shifting for a long time now. If we could reconvene this group in 10 years, will we still be interested in income shifting? Thoughts? Yes or no?
I will still be interested.
All right, I'll go first.
I mean, I think it's still going to be a problem in 10 years at the pace that we're going, you know, so I'm sad to say that I still think it'll be very interesting to study. I'm hoping the data will be better, you know, and I do think after COVID, we're going to need some good revenue sources. And because of the serious income inequality that we've seen in many countries, we're going to need ways to tax the capital side of the tax base as well as the labor. So this is going to continue to be an interest to me, at least.
Yeah, I'm going to say that I think we'll be studying this for a long time unless one of two things happens. Either corporate taxes are abolished or all countries decide to cooperate perfectly, neither of which I think is going to happen. So I think we're going to be seeing income shifting, and I think we're going to be studying it for a long time.
And I was going to add that I feel like I've sort of set myself up for it doesn't really matter what the answer to that question is. I sort of hope so, but because I'm fundamentally just interested in the distribution of corporate profits across countries, that isn't necessarily, and measuring it appropriately and understanding how other countries produce their national statistics, that's sort of a research agenda of mine in general. That's going to be important for a number of different research areas. BEPS is an obvious one, but understanding a lot of different things, you would need to understand the distribution of profits across countries. So for me, I sort of hope we're still talking about income shifting, but my work's going to be important regardless.
Yeah, and very quickly, I think I'm a bit more optimistic than most of my fellow panelists. I think we might be at a turning point, and it's possible that corporate income tax rates are going to start actually increasing in the next 10 years, both because of the important effort by the OECD, because of maybe unilateral actions to tax some of this tax deficit that I was referring to. And I'm actually quite hopeful. I think the solutions exist. We know them conceptually. We also understand that although international coordination and harmonization is best, there's a lot that can be done unilaterally by countries. There's a huge demand for a fairer taxation of multinational companies and corporate profits. And if I had to bet, I would say I think it's possible that we're nearing the end of the race to the bottom, and we might enter in a new phase of maybe a race to the top. So that's my hopeful prediction.
Excellent. Well, thank you so much, panelists, for your active and thoughtful discussions. And with this, we'll turn it over to the next panel, to Thornton Matheson, who will take over from here. Thank you.
Hi, thank you very much. Welcome to panel number 2. The previous panel just did a very nice in-depth presentation on the scope of the income shifting issue. So we now move on to address the question of how income shifting has been addressed by the OECD. And just to briefly recap the history of the BEPS project, it got started up in 2013, a few years after the financial crisis, in response to a long time but escalating measures of the scope of profit shifting, came out with the first 15 action item reports 2 years later in 2015. At that point, it was a project of the OECD and the G20, which was the largest emerging market countries. So over the next few years, the initiative was broadened through the inclusive framework to include more and more developing countries which have special issues with respect to profit shifting, including generally a more limited administrative capacity. It now, as Pascal noted, includes 137 countries. In 2019, the OECD program of work looked at, in greater depth, at 2 areas that grew out of the original 15 action items, but required special attention. Those are pillars 1 and pillar 2. Pillar 1 being a tax on the digital economy. How do we deal with situations where there really should be a digital PE, permanent establishment? And pillar 2 is looking at the global minimum tax. So let me briefly introduce our wonderful speakers. I will, in the order of their speaking. Details of each of their bios are in the accompanying sheet. First speaking will be Manal Corwin, who is partner in charge of Washington Tax, National Tax KPMG. Then we will move to Dan Shaviro, the Wayne Perry Professor of Taxation at New York University. Speaking third will be Victoria Perry, Deputy Director of the Fiscal Affairs Department at the IMF. And finally, wrapping up will be Lisa De Simone, Associate Professor of Accounting at Stanford University. And before we get started, I just want to remind the audience members that they can submit questions via the Q&A. First, let us go to Manal.
Great. Thank you very much. And I will bring it back to basics a little bit and maybe pick up a little bit on the theme of the last panel. And I'll start out by saying I am not an academic. I'm a lawyer by training, but have been doing policy work in various iterations in my career. So I think to assess the OECD response to income shifting, we do need to start with a common understanding of what is meant by income shifting. And that was a question that was posed on the last panel. I think in this regard, it's an important observation is that income shifting means different things to different stakeholders, but it often has a negative connotation, meaning income is being moved from the, quote, right place to the wrong place. This, of course, begs the question, where is the right place for income, and how do you prevent it from being shifted to the wrong place? And on the prior panel, one view was posited that the way you define that is if you have a harmonized tax system, what geography would profit end up in? But again, I think the question is the location of income in of itself the issue, or is the real question whether or not that income is being taxed appropriately relative to the value being created and the business activity, or is it related to economic, whether the income is where economic activity is taking place? So I'm not sure a construct that looks to harmonization alone and where income would end up necessarily connects to is it being taxed appropriately, but we'll get to that. I think it is an important starting point, however, in thinking about how the OECD has approached this. Both of the OECD's BEPS initiatives have been attempting to address these fundamental questions of what is the right place for income and how do you prevent it from getting to the wrong place. To shed light on the complexity of the issues and the evolution of the OECD's response to these questions over the last 8 years or so, and perhaps foresee the direction it might take in the future, I think it's instructive to sort of deconstruct the concept of income shifting a little bit. And first, maybe start by stating the obvious. Income shifting is only relevant to the extent a business enterprise is operating across borders. In other words, if all the activities, assets, resources, and components of a business, with corporate residence, management, production, and market are located in a single national territory, then there's no question as to the location of income and the jurisdiction with the right to tax that income. So in general, this also has been the case when the only thing a business is doing is merely exporting goods to a market. I think the view had been historically the same. Second, and a corollary to the first, is that concern about income shifting is fundamentally about the right to tax when business activities span multiple jurisdictions, and certainly has been the way that the OECD has looked at the issue. Third, the allocation of taxing rights in these circumstances is dictated and agreed by governments in the first instance, and not dictated by business. Obviously, businesses have choice and make decisions based on that baseline agreement, but the starting point of those allocation of those taxing rights is dictated and agreed by governments. In this regard, and in theory, jurisdictions have a sovereign right to enact laws to tax any income they choose to associate with any business activity involving their jurisdiction. So the right for unilateral action has always and continues to exist. In practice and historically, jurisdictions have collaborated on international rules and standards for the allocation of taxing rights associated with business activity that spans multiple jurisdictions. The incentive to collaborate is driven by a number of things. It's a desire to attract investment and remove tax barriers to cross-border investment that would exist or could exist if you have double or multiple incidents of taxation imposed on the same income stream. In other words, if every jurisdiction acted unilaterally on a different basis, the incidence of multiple taxation on the same stream of income would be quite high, and therefore either eliminate that income or change business decisions about their operation across borders. The collaboration also exists to provide certainty for taxpayers, and again, certainty has been tied to economic growth. So certainty both in the compliance with rules and for tax administrators in the ability to enforce those rules. So in this vein, leading up to BEPS 1.0, the OECD's first BEPS initiative, there had been a long-standing conceptual agreement regarding the allocation of taxing rights among OECD countries, at least. And the conceptual components of that agreement were first that the country of residence of a multinational enterprise would have primary taxing rights with respect to the multinational. Second, that market jurisdictions would be allocated taxing rights only to the extent that there was sufficient nexus in the market jurisdiction defined by physical presence or dependent agency, the activity of an agent. And then only with respect to profits that could be attributed to the established nexus. And then third, that jurisdictions that were the source of certain deductible payments and dividends were also allocated taxing rights to those outbound payments, subject to adjustment by bilateral agreement. The international rules and standards that were adopted to effectuate this conceptual allocation of taxing rights were memorialized in the OECD Model Treaty and Transfer Pricing Guidelines and were adopted into domestic laws of the majority of developed countries and to varying degrees by developing countries. So what changed? Well, the OECD's focus on base erosion and profit shifting came into full force after the financial crisis, as was said before, though concerns about it had predated that sort of pivotal point. In the wake of growing concerns about whether current rules were fit for purpose and increased public pressure in some countries to adopt unilateral measures to address concerns, the OECD launched the first BEPS initiative. The principal concern there was the mobility of income, tax competition, and the ability to benefit from hybridity caused by variations in the character and timing of income across jurisdictions created legitimate opportunities for business to structure their operations in a manner that allowed income to be subject to little or no tax, so the double non-taxation concern. So aided by a strong political will to preserve consensus, BEPS 1.0 did not set out to disrupt the agreed conceptual allocation of taxing rights between residence, market, and source jurisdiction, but rather to address the this type of income shifting. So BEPS 1.0 action plan focused on adapting the rules that were effectuating the previously agreed allocation of taxing rights between residence, market, and source to take into account the mobility of value drivers. And it did so by revising the transfer pricing guidelines relating to intangibles and risk, tying it to more physical economic activity or assumptions of risk and control of risk functions, broadening the rules relating to jurisdictional nexus to encompass a broader concept of agency, recommending rules to limit the ability of hybrid arrangements to lead to double non-taxation, so limiting opportunities for arbitrage of differing rules, and increasing transparency and information exchange among jurisdictions to facilitate enforcement.
Okay, thank you. I'm afraid that's all the time that we have. Perhaps we can circle back in the ensuing discussion, but we need to move on at this point to Dan.
Hi, yeah, thanks to everyone for arranging this great panel, and I've enjoyed everything I've heard so far. I'm going to start with a couple of things that just are from listening to the earlier part of the thing today. I agree with Manal that you kind of need, and maybe at variance a little bit with the first panel, you kind of need an underlying notion of what, quote, the true source of income is. I don't blame my good friends, first panel in the slightest, for wanting to dodge some of those hard questions. But the fundamental problem here is choosing between production and market-based definitions of where, quote, value is created or things arise. To give an example, Starbucks has these shops in the UK, they're earning tons of profits. What is the, quote, source of that income? Where is it really created? Where is the value created? Really, there's a production-based definition, which you would say that it's in the US, where they have the folks in Seattle or wherever they are kind of fine-tuning the Starbucks brand, creating IP and so forth. Or there's a market country-based definition, and it's in the UK where they sell things. Now, there's very little valuable production going on in the UK. Sure, they're doing the the coffee, but it's not like they have the world's greatest baristas. So there are two different ways of saying where income arises. One is where production takes place, and the other is where the market is. And there's really no sound basis for saying it's one or the other. But we can be confident that if Starbucks makes money operating in the UK, it wasn't in Denmark that they actually earned those particular profits. Anyway, so there's an underlying problem there, and we kind of have to keep in the back of our minds that production countries and market countries, and it's hard to, there's really no basis for saying which one is quote the true answer. Second thing I want to talk about is the first panel. The name of the panel was "How big a problem is it?" And they all talked about big. They didn't really talk about problem. And I agree that it is that income shifting is a problem. But the problem with the problem is that it's clearer that it's a problem for the world as a whole, for the welfare of the world as a whole, than for any particular country. We have all these countries in the world that are acting based mainly on the self-interest, either of the country as a whole or maybe of the cabal that is running a given country. It's not always clear that it's a problem to them because of externalities and tax competition and difference between jurisdictions. So you have, for example, US multinationals that make a lot of money. Maybe their production work is mostly in the US, creating IP and so forth. Maybe their sales are in places like the EU countries. And the US, and suppose they're paying no tax anywhere. Well, from the US standpoint, there's a question of how high we want to tax them. It's both kind of tax competition reasons for giving them, but also political economy reasons. These people are powerful, they have money, they control the political process. So the actors in the US don't see anything wrong with they're not paying much tax, even if it's actually against US welfare. Likewise, but then would it be better from the US if these companies did pay tax in EU countries? Not necessarily. It's true that anti-tax haven rules countries have create an implication that when you see income paying tax nowhere, you're concerned something bad is going on for you in terms of profit shifting away from stuff you would get. But it doesn't directly make the US better off to have the EU countries levying tax on these US companies owned largely by sort of US founders. Likewise, from the EU standpoint, the EU countries very reasonably in their self-interest, and I think it's globally totally fine, want to tax more of the profits that US companies earn by operating there. But the fact that these companies aren't paying tax in the US either, it kind of adds to the insult, but it doesn't add to the injury. These EU countries wouldn't necessarily be better off if the companies were paying more tax in the US. So the problem of income shifting, which the OECD rightly regards as a problem that as a multilateral institution wants to address, doesn't really match exactly with the type of problem that countries see when they're acting unilaterally and deciding what's best for them, and when even their strategic interactions, gee, we better do this because it'll affect what other folks do, are often somewhat limited given all the rigidities built into political systems. So that's why it's hard to address. I think it's a bigger problem in reality than it is for particular countries that are deciding selfishly and alone what's best for them. And that's sort of the nature of the political economy problem here. Now, the OECD has gone through a bunch of stages. So I regard myself, I'm quite sympathetic to what they're trying to do, but I tend to be more skeptical about how well it's going to work. Maybe that's just the pessimism of someone living in these times in the place where I have to live. Early on, before Pillar 1 and Pillar 2, OECD was talking about value creation, and they were, of course, really trying to get at the tax havens, which was a sensible thing to do. And they are somewhat eliding the question of production countries versus market countries. So that raised that whole problem, which they now, to their credit, they've gone on and they're trying to focus on. So with Pillar 1 really seems to be about allowing the market countries to have a bigger share of, so even if we think that, say, in a production-based view, really Starbucks's profits from operating in the UK are really created mainly in the West Coast of the US, it's perfectly fine for a market country like the UK to say, we want to tax it. I think there's been a lot of literature recently that has reached the conclusion that it's kind of great to give the market countries. It's both easier technically for them to do it. It's easier for them to have the incentive to do it. It's more incentive compatible for them to start doing it. I pretty much agree with that literature. So I'm very sympathetic. I'm sorry. Well, I'm down to 1 minute. Oh, okay. I guess I'm not, okay. I'm very sympathetic. The main problems are twofold. One is that the production countries don't like it, but the US is a very erratic player at this point and not clear if anyone is going to have to worry about what we think. And the second thing is, I would say it's really not just the digital companies' problem. I agree that obviously the digital companies pose this, but again, think of Starbucks. Starbucks isn't exactly digital, but they have IP, and that's where the money comes from. So you really have the problems are for all countries, are for real as well as digital businesses. The last thing I'll say, since I apparently have used up my time pretty fast, is that Pillar 2 is very tough to do. It was tough, and I think one important lesson from GILTI, when you have a kind of global minimum tax, that's like having, it can be like having a 100% foreign tax credit for other taxes paid to other countries. And that's really something that's hard for a given country to rationalize unilaterally. The US having the 80% rate in GILTI, I think that's a great, an 80% foreign tax credit rate in effect in GILTI. I think that's a model that the OECD might find it easier for countries to accept than 100%.
Okay, thank you very much, Dan. We'll move on to Vicky.
Thanks. Can you hear me?
Yes.
Okay. So my role in the panel is basically to talk about the effect of all this on low-income countries, being from the IMF. Before I start, I'll just say that what I'm going to express here are my views and not those of the IMF's management or executive board. But I'm happy to have this opportunity to address everybody. So just to start, just to say that the corporate income tax is actually a larger proportion of overall tax revenues for low-income countries than it is for advanced countries, quite a bit. It's less in absolute terms, of course, and tax ratios overall are generally lower. But personal income taxes don't tend to work very well in countries with low per capita GDPs, low per capita income, or poorly developed administrative capacity. Those countries have really stretched the VAT already. So not shifting away the corporate base is of perhaps even much more importance to the revenues of low-income countries than it is for the advanced economies that we've been talking about quite a bit. So what's happened to date for low-income countries in the last decade? A lot of improvements in the exchange of information actually should help low-income countries to enforce their income tax laws, but it's not clear that they will be given the information they need. That is, will they be deemed to have met the standards of data protection that are required in the global forum? It's also not totally clear they can use it effectively when they get it. Nonetheless, that's very positive. What about the original BEPS? BEPS, we might call BEPS 1.0. The low-income countries weren't represented in the formulation of BEPS 1.0. As we've just been hearing, and I think Dan just mentioned, allocation wasn't addressed. It was explicitly supposed to not be addressed in BEPS 1.0. That is, the idea that low-income countries might not be being allocated their, quote, fair share of the international tax base wasn't touched. Some of the BEPS action items were not of much relevance for low-income countries, and I think, for example, of the hybrid instrument rules. But some actually, despite their not having been represented, do have quite a bit of potential. Quite a bit of potential to help low-income countries. The anti-treaty abuse provisions, the MLI provisions on those that would incorporate some of those rules, and offshore interest in local assets, and country-by-country reporting may actually help them in the longer run. Nonetheless, the subsequent formation of the inclusion framework is really, we think, a very positive for the lower income countries. And that actually is, I think, going to have an impact in the formation of BEPS 2.0. Now, the current set of work, and Pascal, I think, referenced that in some of his opening remarks. So let's look at that. That's 2.0 in the low-income countries. And I'm going to assume here a bit of familiarity with that proposal, but Pillar 1 is the proposal that talks about allocation of income. The thing that's most talked about, that is what they call Amount A, which is the allocation of residual profits, excess profits. Probably won't have much effect. The current quantifications show that there's not a huge effect for low-income countries. The main impact seems to be, as I think somebody's mentioned, loss of revenue in low-tax jurisdictions and some shifting possibly across advanced economies, but really there aren't many residual profits sitting in low-income countries once you get away from natural resources. However, there is something that's much less noted in Pillar 1, which is Amount B, which is basically aimed at low-income source countries and could actually be helpful, which essentially creates a kind of safe harbor, a fixed remuneration on baseline marketing and distribution so that they wouldn't, and that would be sort of mandatory. Everybody would have to go by that. And that would take a lot of pressure off their transfer pricing problems. So that's a positive thing. Sorry. Would straight up formula apportionment help the low income countries? A lot of people have talked about that extensively, likely only if the main emphasis there was on employment numbers. We've done some work on that. You can see papers online. But then let's look at Pillar 2 of the current proposals, the minimum tax proposals that Dan was just referring to those as well. This really could help low-income countries, particularly though if it's focused on inbound profits, that is inbound foreign direct investment profits, which is being referred to as the undertax payments rule. The emerging market and low-income countries are really pushing for this inbound rule, but the current OECD inclusive framework plans would make this a secondary backup only to a minimum tax on outbound investment, which is the income inclusion rule, which is the guilty type approach. So there's a lot of controversy about this amongst the between the low-income countries and who've noticed this, and the advanced economies in this set of negotiations. The indirect impact of even an outbound inclusion rule could be positive, though, since it would minimize the benefit to shifting profits in the low tax jurisdictions, and that would include, presumably, shifting tax base out of the low income countries. So that actually could help. It potentially even could allow such the low income countries to raise their rates if they wanted to. But of course, all this requires that the low income countries themselves don't push for some kind of carve out for tax incentives in determining the appropriate level of tax, which there's a lot of talk about this too, which is a little bit like pushing for tax sparing in treaties for those who are more familiar with that. So there's a lot to be decided here. I see I'm just about out of time. So I'll wind up, but just to say, what's the prognosis? Revenues are going to be needed more than ever when the recovery from the crisis is underway, which may give impetus to the Pillar 2 ideas. On Pillar 1, is this actually going to be a time when anyone wants to reallocate the global tax base, which means away from some countries? Is anybody going to be willing to do that? So I'll just stop there, and of course, happy to take questions later.
Thank you. So on to Lisa.
Great, thank you so much. Just delighted to be here, Lisa DeSimone. And I have the pleasure of going last, which means that I've gotten to hear all of the great presentations from the other panelists, and very just thankful for the organizers for putting this together. I think we've had a fantastic conversation. So most of this panel has given some high-level conceptual thoughts on how we should think about where income is sourced, who should have taxing rights, and what that means for different types of economies. And as the academic accountant on the panel, I want to also talk about some high-level conceptual issues moving forward with the Pillars 1 and Pillars 2 that Vicki was just talking about. But my issues are going to be associated with how we measure income. And so it's going to kind of loop back to some of the conversation from panel 1 of the differences between financial income and tax income. And that's because both Pillar 1 and Pillar 2 are at least in formulation conceptually, are thinking about using financial income, financial statements to figure out how much of that residual income, residual profit should be allocated to market economies, or in the case of Pillar 2, for calculating effective tax rates to apply a global minimum tax. And so we're getting back to this issue that we were talking about before that Scott and others mentioned. There are serious differences between financial accounts and tax accounts, and those differences exist for a reason. We have tax policy intended to try to spur certain types of behavior, including investment, whereas the financial accounts are more supposed to be, conservative for the benefit of the investors in the company, whether shareholders or lenders. So by relying on these financial accounting rules moving forward, it could actually inhibit the effectiveness of tax policies, dampen the ability of a country to try to spur investment, and we could see lower investment in response. There could also be a feedback effect of tax incentives now impacting the financial reports. And so the standard setters and market police, market watchers, need to be aware of the fact that we could have some significant tax incentives, new tax incentives, going into management decisions and management discretion around coming up with their financial reports. There's also significant measurement issues, as I alluded to before. The big one is that both pillars 1 and 2 are looking at using consolidated financial reports, that is, of the entire multinational group. Okay, but which financial accounting standards are we going to use? Is it going to be the standards of the country in which the parent is incorporated, where most of the operations are, that country? Of course, the generally accepted accounting principles vary across country. We could go to IFRS, the International Financial Reporting Standard, but not all companies are using that right now. So there could be significant transition costs to trying to get everybody on the same basis. Alternatively, we're going to have accounts that aren't exactly comparable across companies operating in different jurisdictions. There's also an issue with consolidation about what entities are included. How are we going to treat entities that don't actually get rolled up into consolidated accounts for financial reporting? And that picture could differ from consolidation rules for tax purposes. And then finally, this was alluded to before in the conversation about country by country reporting, that there may be a need to get more at a more granular level of consolidation than worldwide. And particularly for Pillar 2, for example, if we're wanting to calculate effective tax rates on a country by country basis, similar to country by country reporting, that's going to require country by country consolidations. And that's simply not something that companies are doing across the board right now. Consolidation, by the way, is not the same as aggregation. So current country by country reporting is done on an aggregated basis, meaning we're just going to sum up all of the operations. Very different from consolidating everything, where we eliminate certain entries, such as intercompany transactions between related parties. So this is not something that companies are necessarily already doing, certainly not at the level of granularity that we might need. And that's going to be incredibly costly. It's imposing an incredible cost on companies who simply may not have the systems in place to do this. And then my final point is about what figures we're going to use. It's easy to say that amount A that Vicki was talking about that we're going to allocate to market economies in Pillar 1. It's easy to say, well, it's going to be profits, right? Profits before tax. What exact measure is that going to be? And there's two pieces going into that question. First part is it EBIT? Is it something that already adjusts for things like interest payments on debt? So the finer points of looking at a profit and loss statement of a company. But then also we're back to this issue that book accounts are not the same as tax accounts. And so we have to think about the fact that there's income that gets included for tax purposes and excluded for financial reporting purposes, and vice versa. There are differences between these two accounts. Some adjustment seems to be warranted here to get from the financial reporting amount towards a tax amount that won't distort behavior, that won't distort the investment, like I mentioned before. How are we going to treat things like temporary differences in the timing of depreciation? That's going to go into the numerator of the effective tax rate calculations for Pillar 2, and it gets you to a very different answer if we're including those temporary differences. We're treating it as if we're going to pay tax eventually for financial reporting purposes versus, we want that accelerated depreciation for tax purposes. We also have permanent differences and a whole host of accounting issues down in the weeds of things like acquisitions, disposals, discontinued businesses, leases, foreign exchange gain and loss. And I won't bore you with all of those details, just to try to highlight how many differences there are, and that's gonna create a lot of work for coming up with not just which profit number are we starting with, but also what adjustments do we want to make. And I'll end there. Thank you.
Thank you very much, Lisa, and thank you to all our panelists for their comments. I wanted to go around and give you a chance to comment briefly on each other's presentations. But I also wanted to queue up a couple of questions that if we have time to get to. Specifically, Pascal in his keynote speech made, sorry, that was the timer going off. Pascal in his keynote speech described TCJA, our Tax Cuts and Jobs Act, as having a BEPS taste to it. It seems to me there are certain areas where TCJA is quite compatible with the BEPS agenda, and others where it departs from it pretty dramatically. So how is TCJA compliant with BEPS or compatible with BEPS, and where are the differences? And then another comment of Pascal's, and I was thinking Vicky in particular could address it, was, he would like to see a BEPS Pillar 3, which focused on the interests of developing countries. If there were to be such a pillar, what would need to be in it for that constituency? So let's start again with Manal. Could you respond to either other people's comments or one of those two questions?
Yeah, let me address the question relating to TCJA. I think in many ways, the TCJA incorporated a lot of the concerns that were reflected and the recommendations that were proposed in BEPS 1.0. There was a lot of focus during that work on tightening CFC rules as a first order of business. And you've got, the GILTI regime being a full inclusion regime. There was the Action 2 item on dealing with hybrid transactions, and there's anti-hybrid measures within the TCJA, as well as the countermeasures in the form of BEAT. Pillar 2 in BEPS 2.0 really extends the work of BEPS 1.0 and effectively is looking to the US TCJA approach to cross-border taxation and incorporating it into a global minimum tax concept. And so in the work on Pillar 2, they talk about the US being grandfathered, GILTI rules being grandfathered as the model full inclusion rule in Pillar 2, as well as keeping other elements of it. So it really does reflect a lot of the spirit of what was going on in BEPS.
Great, thank you. Other responses to that question or comments on other speakers' presentations?
Yeah, I have a couple things I might say. The first is, anytime I ever speak to any financial accounting professors, they all agree what a horrible idea it is to have any tax consequences assigned to financial accounting. These are people who know their field, who know financial accounting. They know it better than I do. So that reason I'm very respectful of what they say and of their unanimity. But it is true that companies have an incentive, or rather managers have an incentive to overstate financial accounting income and to understate taxable income, and that there's a tension between the two, and that the gap between the two can be of interest. So I think that has to be kept in mind. You risk distorting financial accounting behavior, but it's already imperfect because companies have a lot of sway. So I just think that needs to be part of the conversation. Just two other quick things in response to points Thornton brought up. One is, I know it's an old joke, but I always compare the TCJA to the Monet paintings that look great from a distance, but they look like a mess if you're up close. I think both Guilty and The Beat, for example, have some virtues in terms of what they're trying to do. They're in many respects horrendously badly implemented, reflecting that it was done in 5 minutes with no consultation with the world and so forth. And so they really have some serious problems and defects when you look at them close in. But I realize that's an American perspective, not based on American interest, but that Americans are very interested in particular details. So I would urge anyone outside the US to consider adopting or working off the principles they use, but absolutely not in many ways the very flawed implementation mechanisms. The final thing is, in terms of Pillar 3 or whatever, I do think the issue of global rents of companies that are earning supernormal profits is something that has to be a big part of thinking about all this.
Thornton,
Okay,
would you like me to?
Please go on.
Well, just to pick up on the Pillar 3 idea, I think that, look, at the broadest level, I think probably what Pascal is, well, I shouldn't say what Pascal is thinking, but what I would be thinking is, look, if there's not going to be an effective minimum tax on inbound, in other words, if that just turns into a backup, how are we going to leave a significant amount of tax base, ensure that tax base stays in low-income countries? And I empathize with the view that we're talking about the really low-income countries here, and the really developing countries, not the big emerging markets. So there are various ways of doing that, but I think the complaint that this would lead to double taxation, I think the idea presumably would be, look, if there's double taxation, let somebody else relieve it. Don't structure that way, but leave the tax base in the country where you've made the investment, or at least much more of it. And there are different ways of doing that, depending upon treaty networks, depending on what the rules are about changing the treaties, like either through withholding on outbound remunerate payments on the income, service income. That's already something we're moving toward taxing service payments from low-income countries outward. Recent UN changes in the model treaty. I wonder if I could just ask, reverting back more to the first question about, or reverting back to this idea of TCJA as a model for things, could I ask my fellow panelists, whatever happened to FDII? It seems to have vanished off the radar screen as far as I've seen. Is that an idea whose time just hasn't come anywhere outside the US? What's happening with respect to it? That's a whole different kettle of fish from either the Guilty or the Beat. So I'll just pose that one. And thanks.
Just quickly, I think FDII is an export subsidy, and probably so legally, it's certainly so economically. I gather the companies weren't that excited about it, partly because they were worried about its future. So I've been made happy by its eclipse. But if countries are going to trade wars and the like, we may see more things like that in the future.
Okay, I just wanted to make sure that Lisa had a chance to offer any comments, either to her fellow panelists or on the question of TCJA as having a BEPS taste.
Great, thank you, Thornton. I do want to pick up on one of the comments that Dan raised about financial reporting incentives versus tax incentives. And the comment particularly was that managers always have the incentive to overstate financial reporting income. And I would push back on that a little bit. I think it's well established within the accounting rules that you can't do that forever. So you can pick and choose and try to meet or beat particular earnings targets, and also maybe try to smooth income over time. But I don't get the sense from the literature that I've read anyway that there's this incentive to always overstate. And sometimes, in fact, it's built into the financial accounting standards that it does get overstated relative to what we would see for tax purposes. A clear example, hopefully for everybody, would be the movement in a financial accounting towards fair value accounting and having to book for your financial accounts unrealized gains gains that you haven't actually cashed out. And that stands pretty well in contrast, in my view, to this notion from the tax law of having the wherewithal to pay tax on that. If you haven't actually liquidated that investment, you don't have the ability to pay the cash in order to pay the tax on that. And that could really hurt a lot of companies and put them in a difficult position. So I think there are a lot of different tensions, and it's not just easy to boil it down to just over-reporting versus under-reporting incentives.
I think that's a fair point. I think when there's the overstating thing, it often has to do with managers with short time horizons. That's really where that would come from. Absolutely right. In the long run, what you say is exactly
That's
right.
fair.
Thornton as our leader.
Sorry. Yes, so thank you very much. I think with that, we will move on to some of the audience Q&A. Here's a question for Dan from Tim Dowd of Joint Tax. Under Pillar 1, OECD is contemplating only consumer-facing companies. Can you discuss your thoughts on whether this is sensible? Should the OECD apply it Pillar 1 more broadly? And yeah, that question was directed specifically to Dan, but after Dan addresses it, please, if the other panelists have views, please feel free to chime in.
Yeah, if I'm understanding consumer-facing companies, not absolutely sure I understand the term. I know it has a meaning. I would say basically market countries have an interest in sales and revenues generated by interacting with people in their jurisdictions, whether it's a consumer-facing business or not, so very possibly more broadly. So kind of the question is, are they generating value from transactions directly or indirectly from consumers in the country, and how shiftable is it under other mechanisms? But possibly yes, more broadly.
Do any other panelists care to comment on that question?
Maybe just a quick comment about something Pascal said about the attitude around the table. The OECD had, and for a long time, and the US position was you can't ring fence the digital economy, and so the work in Pillar, in BEPS 2.0, particularly on Pillar 1, ought to take an approach that doesn't ring fence the digital economy. And he was suggesting that now some are saying, well, in fact, the digital economy is ring fencing itself in the current environment. I think there's an argument to be made that this environment is actually accelerating and reinforcing the notion that the digital economy is the economy, and that's accelerating it. And my concern, there's been a lot of talk about it, Pillar 3. My concern is a BEPS 3.0, which is, that we keep coming back to the drawing board, rethinking, Pillar 1 already is rethinking the allocation of taxing rights, and there's a debate about, do you go to just digital, do you go to consumer facing, whatever gets done, if it's sort of one small step and then we start over again on a BEPS 3.0, because fundamentally this is about a dissatisfaction among market and source countries as to the original allocation. Is the certainty agenda and the importance of certainty worth getting the kind of broad-based agreement right in the first instance, rather than slowly watching kind of this unraveling of the global consensus and the proliferation of unilateral measures? And I think that's an important consideration.
Okay, thank you. We have another question here from Dia Justizia of, I believe, the Tax Administration in Indonesia. It's a two-part question. What is the best approach to consensus for fair allocation in taxing rights Pillar 1, marketing intangibles or user participation? And what is the development of these approaches for a unified approach in order to combat profit shifting? Can any of the panel address that? Then the second part is, what is the best information to allocate the profit for, sorry, appears to be a repetition. We also have a question from Asaf Harpaz of Duke Law School. Several commentators have compared both digital service taxes and the OECD project to consumption taxes, for example, the VAT. What do you make of this comparison?
I don't think of them as that similar myself. For example, under, say, Facebook gives free access to users to the platform. So under a conventional, because of course they're getting they make money off the third-party advertisers and the like, and info miners. It's not really quite a consumption tax issue of how much under consumption tax UK people who are using free Facebook should pay consumption tax to the UK. It's really a question of the UK's interest in sort of having some of the global profits go to them rather than either to no one or perhaps the US where the Facebook people are. So I think the issues, consumption tax and income tax is well known. It's kind of about the return to weighting. That's not really the issue here. The issue is really about allocating between countries and about some place versus no place getting the revenues.
Thornton, if I might just add on that.
Please.
Some have compared the digital service the turnover type of digital service tax, which I think Dan was alluding to also. Some have compared that not so much to a VAT, but rather say to a royalty akin to a natural resources royalty. It's basically just a flat rate on an amount without regard to who's consuming it or what the value is, or certainly without regard to the income. And so in that sense, maybe more like a royalty. Some argue that's good, some argue that's bad, but that might be a better analogy, actually.
Very good. We've talked quite a bit about Pillar 1. Just to turn to Pillar 2, it's sometimes the U.S. GILTI is seen as a model for the type of global minimum tax that would be promulgated under Pillar 2. In what sense does GILTI make a good model for a potential Pillar 2 type tax, and in what sense does it not?
Well, one thing that's bad about it is I think the sort of the 10% real income rate of return that puts the first I into GILTI. I don't think that's really a great idea. Even if you want to have normal returns excluded, I think that's a bad way to do it. GILTI was also way easier because we just have one country doing it. So we don't have to worry about all the problems that the OECD has to worry about different countries having different tax bases and different measures. So the US, by unilaterally doing GILTI, managed to avoid a lot of the problems that the OECD is rightly worrying about, and that's why they're talking about using financial income and things like that. So we kind of had it easy, and unfortunately, they're going to face some tougher problems that we didn't have to worry about.
And if you please go ahead. Was that
Great.
Manal?
I just wanted to. It's Lisa. I just wanted to jump on Dan's point there. I think another big difference, at least conceptually, between GILTI and what might be done at a more international level is that GILTI applies everything on a worldwide basis. So, you know, and I think there's still that's the notion still for the OECD, but there's still some conversation about whether that's really getting at what we want to get at. You know, the ability to still kind of use shifting in one jurisdiction to offset something going on in a different jurisdiction. There's still, companies are still able to play that game under a worldwide GILTI type approach. And if we really wanted to disincentivize that and get rid of that, it needs to go more country by country.
Just because I think Lisa has a great point there, but I want to separate two things. One is, it's well known that all else equal, a per country system will be much more tougher on companies than a global system. But in theory, you could take the two types of system and make them equally rigorous. For example, have a higher rate in one than the other. Structurally, I think the per country makes more sense, even if you want to reduce the rigor, simply because the types of games Lisa just adverted to doesn't really make a whole lot of sense to give companies incentives to sort of play games with a low tax country here and high tax country. It's just wasteful stuff. Be as tough or as mild as you want to be, and don't really have them jumping through those hoops affect the answer they come up with.
Maybe just one last point, not so much about the construct or the mechanics of guilty itself, but how it fits into the broader ecosystem of what Pillar 2 is supposed to do in connection with the undertax payment rule. If guilty is the full inclusion portion, the way it's supposed to interact with an undertax payment rule is that any provisions that the U.S. have, the U.S. beat, for example, and that it is part of a condition of the grandfathering that's being discussed, is that when another jurisdiction has adopted an acceptable full inclusion regime, whether it looks like guilty or something else, the U.S. Under the discussions would have to turn off the beat. But our beat is not really based on whether or not income is undertaxed from the perspective of the taxes that are incurred in other jurisdictions, but is tested against sort of an alternative minimum tax concept in the U.S. And is flawed in many ways. I agree with Dan. There's a lot of issues with some of the regimes that we've adopted. I think eliminating the beat as a condition of any sort of Pillar 2 agreement where there's an acceptable full inclusion regime on the other side makes a lot of sense, and it is not necessarily a regime I would recommend for imitation.
Okay, great. Well, thank you all for your comments. It's time to turn the baton over to Eric for concluding remarks. Are you there, Eric?
Yeah, I'm here.
Okay.
All right. Well, I really learned a lot this morning. It's been a great conference, and I want to thank all the participants, and particularly the panelists and speakers who did a fantastic job and really was an outstanding group. So I thank you very much. TPC has done this conference. This is our third year we've done this with the University of North Carolina. I would like to thank my colleagues at UNC, particularly Courtney Knoll, Ed Maydew, and Jeffrey Hoops, who did a great job in working with us in organizing this panel. This year has been particularly challenging because we were hoping to have this event at the Urban Institute. We were not able to do it, but I think we've made the transition to Zoom, at least for a time. That's posed some challenges, but also some benefits as a result of being on Zoom. We've been able to get participants in the panels who would not have been able to travel. And so that's been a great benefit to us. And also, I think looking at the list of listeners, we had many people tuning in from all over the world. So I hope we'll be able to do this in the future. The UNC organized the technical aspects of this. And I want to particularly acknowledge Dominic Abenanti of Academic Technologies, who really put together all the technical aspects of doing this by Zoom. And thank you, Dominic, for helping us. This has been very successful. I also want to thank some of my colleagues at the Urban Institute. Ann Clevin of the Tax Policy Center did her usual great job in getting us organized and making sure this happened. And also Haley Romer and Nick Laughlin of the Urban Events team. So that's all I have to say. I guess to refer to what Pascal said in the opening session, I hope we're getting beyond being baby Zoomers, and thank you all very much.